Welcome to The Debate. Today, we are conducting a deep dive analysis of Honda Motor Co. Ltd. based on the March 4, 2026 close read report. We are looking at a fascinating tension at the heart of this original equipment manufacturer. The central disagreement we are exploring today is this. Is Honda a massively mispriced deep value asset trading at a 95.5% margin of safety, or is it a classic value trap masked by stale data, collapsing free cash flow, and historically poor management candor? I represent the view that Honda's deeply discounted valuation, specifically its 0.48x price-to-book ratio, and its massive cash reserves, provide an asymmetric margin of safety that overcompensates for the EV transition risks.
And I represent the opposing view. The bear case here is that a multi-billion-dollar negative free cash flow swing, severe data discrepancies, and a bottom decile disclosure record point to structural deterioration. When you look under the hood, the perceived value of this asset is simply being destroyed by the realities of an incredibly capital-intensive pivot.
Right. So to set the baseline for this IC meeting, my perspective is grounded in the fundamentals of value investing and the empirical output of our screening pipeline. Honda falls cleanly into the Track 2 deep value tier. It has a top decile price grade A, placing it in the 91.2nd percentile, screening CSV page 1. But the most compelling evidence comes from the Penman residual income model. If we look at the base case, the intrinsic value is roughly $86.3 billion. Compare that to a market cap sitting at just over $44.1 billion. That is a 95.5% margin of safety. Penman model, page 4. What the market is doing right now is pricing in a perpetual terminal growth rate of negative 2.32%. It is essentially assuming continuous perpetual destruction of residual income. I find that logic incredibly flawed because despite the genuine challenges of transitioning to EVs, Honda's operating income sits at a robust $8.0 billion. Symphon TTM FY 2024 Q4 P2. Furthermore, the balance sheet is an absolute fortress. They are holding $31.0 billion in cash and short-term investments. That covers nearly 63% of their total debt and provides an 8.6-year runway, even if we assume the current rate of cash burn continues unabated. The company is priced as if it's going extinct tomorrow, but they have the fuel to navigate the storm.
Well, I come at it from a completely different angle. The valuation metrics you are citing are a mirage. They are built on stale data and, frankly, structural decline. Let's look at the quantitative risk profile. The Layer 5 machine learning model assigns Honda a reject track with a dismal 0.50 compounder score. ML model scores, page 3. It completely fails the quality bar. And we have to ask why the model hates it so much. It's because of severe fundamental degradation. Look at the catastrophic collapse in free cash flow, or FCF. According to the Symphon trailing 12-month data, FCF fell from a positive $12.4 billion, which was a fantastic 9.8% margin back in FY 2022, to a negative $1.35 billion, Symphon TTM FY 2024 Q4, page 2. That is an almost $14 billion negative swing. Why? Because implied CapEx roughly doubled to almost $7.8 billion just to fund this EV transition. And layered right on top of this financial decay is a massive credibility gap.
The FY 2025 management's discussion and analysis received a candor score of 3 out of 10. The extraction pipeline yielded 0 extractable forward-looking claims, disclosure assessment, page 5. This is happening precisely when transparency is most desperately needed regarding the pending Nissan merger and the severe U.S. tariff headwinds. You cannot underwrite a margin of safety when the data is conflicting and management absolutely refuses to speak.
I see why that negative cash flow number jumps out at you, but let me give you a different perspective on how to handle these data artifacts. As analysts, we have to treat data artifacts as first-class issues. I will steelman your point right out of the gate. Using Morningstar's 13.5% FCF yield or 20.4% buyback yield is dangerous. We have explicit staleness warnings on those metrics in the screening pipeline, and relying on them without manual verification is a rookie mistake. Furthermore, they're the critical FCF source conflict we have to acknowledge. CIMFIN shows a trailing 12-month FCF of negative $1.35 billion, while Morningstar's latest figure claims a positive $5.1 billion. Morningstar CSV, page 2. There's also a massive 10 percentage point divergence in gross margin for FY 2022 between CompuStat at 29.1% and CIMFIN at 19.7%. Cross-source financial reconciliation, page 6. But here's where we diverge. If we do the work to resolve these artifacts, the picture changes. That gross margin gap is likely due to differing GAAP versus IFRS cost reclassifications, specifically whether depreciation is lumped into the cost of goods sold. The FCF gap is driven by different CapEx and financial services scope definitions. When you strip away the noise, we are still looking at an industrial business generating $6.4 billion in operating cash flow. This is a cycle-tested operation with massive operating leverage.
That's a compelling argument if we lived in a vacuum. But you have to consider the implications of that cash flow when you factor in massive capital demands of the auto industry right now. So let's move into a cross-examination here, because I have some hard questions about how you are modeling this. Let's start with my first question. Operating cash flow is great, but it doesn't build battery plants. If you acknowledge that the CIMFIN negative $1.35 billion FCF is the more accurate reflection of their current EV capital cycle, how exactly do they fund the $10.7 billion in total capital demand? They have $7.79 billion in CapEx and $2.28 billion in dividends to pay. CIMFIN TTM FY 2024 Q4, page 2. How do they cover that without further leveraging their captive finance subsidiary? They cover it with the $31 billion cash buffer I just mentioned. Even with an annual net drain of roughly $3.6 billion, the runway is 8.6 years. It's more than enough time to bridge the EV transition cycle without facing a liquidity crisis or dangerously over-leveraging the captive sub. But let me turn a question back to you, my first for you. Let's look at that gross margin discrepancy. If that massive gap is merely an artifact of CompuStat excluding depreciation and amortization from COGS, and the true underlying margin is the Morningstar-aligned 20.8%, doesn't that prove that core auto manufacturing unit economics are actually incredibly stable? Doesn't that directly undermine your thesis of structural degradation?
It doesn't undermine the thesis at all when the operating leverage is turning severely negative. We are looking at negative 28.0x operating leverage between FY 2023 and the trailing 12-month FY 2024 period. You can have a stable gross margin, but if your operating costs to push those vehicles out the door are skyrocketing, the core economics are degrading. Which brings me to my second question for you regarding the data discrepancies. It's not just some minor accounting quirk we can wave away. Morningstar says you have a 4.0% FCF margin, and CIMFIN says it's negative 1%. That is a $6.4 billion chasm. It massively exceeds the 10% operating income materiality threshold. Building an intrinsic value calculation on data that conflicting is like building a house on sand. How do you actually underwrite a specific valuation with a spread that wide?
You underwrite it by deconsolidating the financials, which brings me to my second question for you. If we reconcile that Morningstar positive $5.1 billion FCF and the CIMFIN negative $1.35 billion FCF, by explicitly isolating the captive financial subsidiary, Honda Financial Services, we see the industrial parent actually maintains a net cash position of roughly 1.5 to 2.5 trillion yen. Doesn't isolating the finance arm prove the industrial core is perfectly solvent and the debt inflation you cite is just a normal, expected artifact of running an auto loan book?
Well, the light LGBM distress model flagged the free cash flow margin with a feature gain of 9,087. That makes it the single most predictive distress signal in the entire dataset. ML Model Scores, page 3. It flagged it precisely because the industrial core is bleeding cash to fund the EV transition. Yes, the captive finance arm inflates consolidated debt to equity, which the model also flags with a gain of 2016. I will gladly concede that is a known structural false positive risk for OEM distress models. It's a classic auto analyst trap. However, you cannot simply hand-wave away the negative free cash flow momentum at the consolidated level when CapEx is hitting 5.5% of revenue. The debt is real and the cash burn is accelerating, which leads to my third question. You are anchoring on book equity in the Penman model, but let's look at return on invested capital, or ROIC. It ranged from a meager 3.1% to 5.7% across the CIMFIN FY 2019 to FY 2023 cycle. CIMFIN TTM FY 2024 Q4, page 3. That is structurally below a typical 7 to 9% WACC. The machine learning compounder model flagged this heavily. ROIC has a feature gain in